Hi, welcome back to EY's IPO Knowledge Series. Tax and structuring is really a foundation stone for any IPO journey and very strategic. Pranav, thank you for joining us.
Thank you. Pleasure.
We'd love to hear from you on what are the key considerations a company should have when they're looking at their tax and structuring.
Especially in the context of an IPO, Veenit, one of the first things that we would look at is the corporate structure as it currently exists. And particularly because in the Indian context, we see that on many occasions there are multiple companies housing various different assets, liabilities, businesses or parts thereof. And what's important to ensure is to see which particular entity one would like to go for the IPO and what would be the key ingredients of that particular IPO entity. What would need to go into or out of that particular entity to ensure that the full transaction perimeter is appropriately covered by that entity. Typically, that would involve some pre-IPO restructuring steps, which would make sure that the right contents are contained in that particular IPO entity for it to be IPO ready by consolidating other assets, liabilities into it or carving out certain assets, liabilities out of it in order to ensure that the perfect mix of assets, liabilities and businesses are housed in the IPO ready entity ultimately. For instance, one of the things that has been noticed frequently is there might be a shared intangible, maybe intellectual property rights like a mother brand which are used by various different businesses of the group. What would then happen is an appropriate arrangement needs to be placed to ensure that there is clarity both for the investors in the IPO and for the rest of the group entities as to how that particular shared intangible is going to be owned, licensed and so on for each of the entities to continue their use post the IPO. Another critical factor, for example, is how the capital structure of the company looks like eventually post the IPO. Because indeed one would imagine that an IPO listed entity would have a much broader capital base, a much larger number of shares in order to ensure much wider participation amongst investors. So there are several such factors, as I mentioned, which one looks at when one is planning for an IPO.
Thanks Pranav. And it's interesting because the transaction perimeter would then lay the foundation for the financials, for the overall equity story. So it's really building that foundation stone.
Absolutely.
I would love to just hear a little more. Can you just elaborate what you meant by capital structure and how should a company think about that?
Right. So when we talk of a capital structure of a closely held unlisted company, typically there would be a small number of shareholders, which is fine, and the number of shares may also be very small. When one looks at it from an IPO standpoint, one has to closely examine the number of shares in the capital structure, the size of the share capital in rupee terms, the company's valuation and what that would translate to in terms of the per share price for the IPO marketing. And it's important to get all this right to ensure that it's properly understood and investor appetite is appropriate. While we try and bring together or put together the appropriate capital structure, one could look at various options like issuance of bonus shares or stock split where 100 rupee share could be split into face value of 10 rupees or 1 rupee for that matter and so on and so forth. So as to expand the number of shares or the size of the share capital itself, there could at times be convertible instruments like convertible preference shares or convertible debentures which may need to be converted pre the IPO. We just spoke about corporate structure, which could involve consolidating some entities or carving out some assets, liabilities, businesses. That could impact the capital structure as well. So overall, we need to ensure that just when the company is ready for an IPO, it is likely to have the right capital structure in place so that the number of shares can enable a broad-based shareholding as well as an appropriate IPO price.
Sure. No, thanks for sharing that. And what I'm hearing is therefore, the corporate structure, the capital structure, the sequencing of events, and especially when you bring it in the context of a fast-moving or a fast-growing company, then that needs to be continuously re-evaluated or assessed, because what may be the price today will be very different from a 1 year or 2 year price down the line. So how should a company really think about in terms of timing and the cost implications of this?
Right. Now, very good question, Veenit. The way all this has implications is not only from a company standpoint, the consolidation carve-outs can have tax implications from a company standpoint. Also, it has significant implications from a shareholder standpoint. And for different shareholders, it could have very different implications. But issuance of bonus shares, stock splits, conversions, all of this can have implications from a point of view of what would be the capital gain and taxability in the hands of the shareholders if and when they dispose of or sell the shares. For example, as we all know, the period of holding is impacted by the issuance of bonus shares. So the cost of acquisition could be very different when it comes to bonus share issuances versus a stock split, and so on and so forth. And all of this could have very different implications from a capital gain standpoint for the shareholder. Similarly, the facts and circumstances of the shareholder come in as absolutely critical, because each shareholder may have entered the company at a different point of time, may have entered the company at a time when the valuation was very different, so his cost may be very different. Some may be resident shareholders, some may be non-resident shareholders. Within non-residents, there might be those who are entitled to a particular treaty versus another or none at all, and so on and so forth. All of these could differ widely among shareholders, and therefore the implications for different shareholders can be extremely different, and their interests need to be properly aligned so that all the shareholders are happy about the way the restructuring is being done and the capital structure is being changed. And so long as we can take all the shareholders' interests and keep it in mind so as to align their interests and move forward, it typically works best in our experience. Also, in terms of timing, I would feel the earlier one starts evaluating and thinking about it, the better it is, because as you know, these steps sometimes take a certain amount of time to execute and implement. Also, there is a certain time required for a share to move from short term to long term, for example. And that's something that all of us are aware, that long-term capital gains has a far more favorable tax treatment. So all of these considerations need to be kept in mind while we are planning an IPO, so that there's enough time and one doesn't need to rush into an IPO.
And probably just a few themes on what you're seeing otherwise in the marketplace as well, and any advice that you'd have or suggestion you want to share with our viewers?
Well, when it comes to an IPO, there are so many things that one needs to look at. So for example, frequently we come across situations where promoters' shareholding is quite fragmented amongst various different individuals, sometimes HUFs, promoter holding companies, and so on. How do they see themselves holding the shares of the company in future? How are they going to operate as a single block with one voice? How do they plan succession of the shareholding in a longer time frame, and so on? And let's face it, a lot of these appropriate shareholding structures, for example from a promoter standpoint, can be far more easily and flexibly achieved if one does it pre the IPO while it is still a closely held company, versus starting to think about it after the IPO is done, which makes it far more complicated, sometimes very costly as well. So the tax regulatory considerations need to be always borne in mind, and planning for all this while the restructuring pre-IPO is happening can enable you to evaluate far more efficient options to achieve the desired result. Similarly, one looks at, for example, in today's day and age, there are several cases where people want to list in India, but the real holding company which captures the value of the business is outside India, into which various investors have invested. As we know, it is not possible to list an overseas company in India, so it requires restructuring to ensure that the Indian vehicle is the one in which all the investors are invested, and that's the vehicle that goes for eventual listing, which itself, as popularly called internalization or reverse flip or ghar wapsi. And it's become extremely interesting now because Indian capital markets have come on their own and really give very good valuations and depth in terms of liquidity. So certainly that's something that one has started looking at. Of course, that's a subject by itself, some of these, and probably deserve a separate episode by itself.
Thank you, and thank you, Pranav, for sharing your knowledge with us.
Thank you.
Appreciate
So much.
And should our viewers have any questions, we'd be happy to share more insights with you. Thank you.
Absolute pleasure. Thank you. Thank you, Veenit.